if we do see a Fed hike this week, from an emotional standpoint, many investors may move to the sidelines. However, ETF flows tell us a lot. Since the low in 2009, investors have bought the dips. They haven't yet, but they haven't sold. So far, we've had record inflows into ETFs so far this year, which has been very, very positive. In fact, even in the last month, positive in the S&P 500, and surprisingly, more people buying emerging markets than selling emerging markets. However, small businesses make a big impact on markets, and they really ran most of the GDP growth in the last couple of years. If we see a sentiment move to the downside in the next few weeks and selling in ETFs, that could move us lower.
We just hit a fresh session low, Kenny, 466 points lower on the Dow, basically down 2% of all the major indices. What do you make of this? Not just ongoing significant sell-off, but broad. All the sectors are lower again. Is this concerning you for the rest of the year?
Well, it is concerning me for this year. I think that Santa Claus rally that we talked about a month ago, I think that's gone. I don't think he's coming at all this year, which is a little bit frustrating, I think, for a lot of people. But, you know, when we broke on Friday, and Friday is significant because the market was under pressure, it closed on the lows right below both the October and November lows that we created. So that just set us up for exactly a day like today. And this 2550 level on the S&P was a level that we've been talking about. I pointed it out in my note this morning. We're right there right now. We seem to be holding there, but there's not a lot of support there. So if, in fact, the tone continues to be negative, then I think a push to the February lows at 2530 is clearly in sight. I'd rather not see it happen, but I think if they keep accentuating the negative, that you're going to, the market, the momentum guys are just going to push it there.
If it's about sentiment, Rick, how much optimism or pessimism is baked into the bond market at this point?
Well, the bond market's holding in rather well. Obviously, yields have come down, but they've come down at a point where over the last week and a half or so, we've seen, especially the mid to long end, prices at levels and yields at levels that we've held on a closing basis. So that gives me some confidence. With regard to Mr. Gundlach's remarks, of course we're in a bear market. To me, the only question is, are we in the bear market? And as far as data points, you talked about confidence. Let's look at a couple of the data points just today. National Association of Home Builders, lowest level since May of 2015. We had the Empire, lowest level since May of 2017. So there's definitely something going on. But I'll tell you what, I know that it's a small window, but if there is a Santa Claus rally, I think it's in the hands of the FOMC committee, because most likely they will raise rates. But exactly how they discuss it afterwards will be key and definitely could trigger a several session rally. Ultimately, I guess what gives me the most confidence is from a global perspective, we are still doing the best. There has been some deterioration. And as much as our central bank is in this argument about politics versus policy, I think the Wall Street Journal op-ed written by Mr. Warsh and Mr. Druckenmiller really does express the notion it should be about policy. And I would think that many believe that Jay Powell and company probably isn't really so knee-deep in this notion of a confrontation with the president that they would do anything that wouldn't be in the best interest of the economy and good policy.